Today I want to talk about the need for tax cuts to help boost the Australian economy. We were quite disturbed to see the retail sales report earlier on last week that showed that retail sales for the September quarter in real terms actually contracted by 0.1%, and over the year retail sales had also contracted in real terms. We hadn't seen that since the early 1990s. So clearly the consumer is struggling at the moment. We've seen the Reserve Bank cut rates on 3 occasions, in June, July and in October. And we also saw the government provide some lump sum tax cuts in July, August, September. But that didn't seem to make much of an impact upon consumer spending. My expectation is that the Reserve Bank will cut rates on one more occasion. And that is likely to be in February, when we think that they'll cut for another 25 basis points down to 50 basis points, and then we'll see the Reserve Bank move into some form of quantitative easing. I think they have to do that because if they appear to the market that they've finished with their easing cycle, the Australian dollar will get some most unwelcome upward pressure. So the Reserve Bank needs to keep the market believing that they're continuing to ease financial conditions, even though they're unlikely to push interest rates much lower than 0.5%. In fact, we saw a few weeks ago that the Consumer Sentiment Index actually fell by 0.5%, even in the aftermath of the Reserve Bank cutting rates in October. So I think what's happening there is that the consumers are looking at these very low interest rates and being concerned that this is indicating that there's something wrong with the economy, and are getting nervous. So there's not a lot more that we can do with lower interest rates, but as I said, I do think that they'll cut once more. What else has happened, of course, is that the government has legislated tax cuts. And the next stage of the legislated tax cuts is due to begin in July 2022, $14 billion worth of tax cuts. My issue is that I think that they should bring those tax cuts forward to July 2020. The profile for the surplus going out is a $7 billion surplus for 2019-20, an $11 billion surplus for 2020-21, an $18 billion surplus for 21-22, and then going back to a $9 billion surplus in 22-23 when those tax cuts are imposed. The cost of the tax cuts is around $14 billion in a year. So clearly if they introduced all of the tax cuts in July 2020, that would push the deficit down from the expected surplus of $11 billion to a deficit of about $3 billion. The government may be uncomfortable with that, wanting to deliver on their promise to deliver surpluses going forward, and that of course was a key election promise. But what they could do is deliver half those tax cuts in 2021, which would leave a thin but a workable surplus of about $4 billion. Then the other half in the following year, which would leave also a thin but a workable surplus of around $4 billion as well. I believe they could also, if they were giving those tax cuts, they could also boost their growth forecasts. That would, of course, would also help the fiscal position. This second tranche of tax cuts is likely to have a more direct impact upon household incomes than the first tranche. The first tranche was around one-off payments to about 30% of the population. In the second tranche, they're moving thresholds. So people who move from a 19% tax rate to a 32% tax rate don't do that until they go to $45,000, whereas at the moment it's $37,000. And those moving to a 32.5% tax rate to a 37% tax rate don't do that until $120,000 rather than $90,000. So what you'll find is that every week people will get more money in their pay packet, and that will mean that there's much more likely to filter into spending than one-off payments. So it's going to be a more effective set of tax cuts in the second round, and therefore I'm much more optimistic that it'll have a positive impact upon spending than we saw in the first round of tax cuts. So I think the options are there. Obviously infrastructure is a concept that people find attractive, spend a lot of money, build a lot of good stuff. That's absolutely right, but what we're finding at the moment is that in Sydney and Melbourne we're running into supply constraints. There have been huge cost overruns on existing projects. The ability of people to supply new services is being limited. So I think the infrastructure story is a good story, but I think we can probably get better results by improving the productivity of existing infrastructure. And that would mean maintenance and repairs work on existing infrastructure. Cost a lot less money and still allow that surplus to be achieved. So I think the government has a very, very attractive option of moving those tax cuts forward. It would mean thinner surpluses. I don't think that would in any way affect the world's opinion of Australia's strong fiscal position or in any way threaten our AAA. And it would get the economy moving because at the moment the situation is difficult. Interest rates are not doing much of their work. New tax cuts would be the way to go. Thank you very much.